Hello, everyone, and thank you so much for attending week 4 of BFSG's 4-part fall webinar series. I'm really excited about today. For all of you that have an employer-sponsored retirement plan, we are here to talk about those plans and why you should save, why you should engage. But before I get into housekeeping, let me introduce two people that are going to be here today with us, Antonia and Tina. You guys want to give a quick introduction? I'll go back to housekeeping afterwards.
Certainly. Hi, everyone. My name is Tina Schackman. I'm a senior retirement plan consultant and a certified financial planner professional. And thank you all for joining us today.
Hi, everyone. My name is Antonia Lipovac, and I work closely with Tina and several others here at BFSG. I serve as a client service manager.
With that, let me give it to Tina as we get back to this thing. Tina.
Okay. All right. Well, let's kick things off. I thought it would be important to talk about why retirement planning is so important. One of the main questions we get from clients that are getting close to retirement is, are they going to be able to maintain the same lifestyle they had when they were working? Basically, what they are asking is, did I save enough to replace 100% of my income when I retire? And we can run several simulations to give them an estimate of how much they'll be able to spend based on what they've saved. But if this question is asked only a few years prior to retirement and they didn't save enough, there isn't a lot of time to take action. So it's never too early to start planning for retirement. Another benefit to retirement planning is to help ensure there's enough savings to cover any unpredictable costs that may come up during retirement, such as healthcare, home repairs. And longevity is another key consideration as people are living longer. So the need to plan for potentially 20 to 30 years beyond retirement becomes even greater. One way to help maximize your retirement savings is to develop a withdrawal strategy based on the types of accounts that you may own, such as a 401k or another qualified account, or after-tax savings like a brokerage account. And many people think that once they retire, they should just move all their assets into cash or bonds. But having some equity in your portfolio can help stretch out your savings by growing your investments during retirement. And while you can't control inflation or market volatility, we actually discussed that in a prior webinar about navigating market volatility. Having a plan to navigate these risks and sticking to it will increase your odds of having a secure retirement. And one way to start planning for retirement is participating in your employer's retirement plan if you're eligible. So that brings us to our first poll.
I love it. All right. So all of you, you know that we like to launch polls here to keep you all engaged. I'm going to launch this thing right now. It should pop up on all of your screens. If you're logged on a computer, are you currently participating in your employer's retirement plan? Now, I know the vast majority here are coming from some of our institutional clients, which means you definitely have a plan. So that last option should not apply to most of you, although this is a nationwide and public audience. So we know some of you may not have access. And if you don't, let us know. We're happy to see it. We would love to talk to you and we can tell you how to save in IRAs and other ways to just maximize this thing. So with that, I think most people have actually already responded. So let me close this thing out. I'm going to share results with the group. We have 91% Antonia and Tina say, yes, I'm already saving. They're just here to learn.
Hooray.
Only 5% said no, 2% said I'm waiting to evaluate the plan, and a couple of people say, I don't even have a plan. So maybe we can talk to them separately. We could teach them IRAs, but I think this is pretty compelling. Great. Good to see.
Yeah, it's great to see. And I think a lot of the things that we're going to talk about today will certainly apply, but we do want to address the fact that, there's a lot of benefits to the retirement plan. So we'll get into all of that as well.
So yeah, before we dive into the specifics of how retirement plans work, it's really important to understand how we got here in the first place. So back in 1875, the first private corporate pension plan was introduced. The American Express pension plan was fully funded by the employer and was only available to employees who were 60 or older, had 20 years of service, and were no longer able to continue working. If an employee met all of those conditions, they were able to receive half of their annual salary in retirement. Fast forward to 1935, the government got involved and the Social Security Act was signed, which would be funded by payroll taxes paid by both employers and employees. The retirement age to receive these benefits was initially set at age 65, And then later, this was amended to allow for reduced benefits beginning at age 62. So with Social Security established, private sector retirement plans also evolved. However, many of these plans were poorly managed, resulting in thousands of employees actually losing their retirement benefits, most notably the Studebaker collapse of 1963. In response to some of these failures, the Employee Retirement Income Security Act, known as ERISA, was enacted in 1974, and really this was to set minimum standards for private sector plans. So with ERISA in place, the Revenue Act of 1978 quickly followed, which essentially created the modern 401k system. So this allowed employees to defer a portion of their income on a pre-tax basis to save for retirement, and this benefit meant that contributions would not be taxed until withdrawn for retirement, and employers could match these contributions to further help employees save. Over the next 20 years, 401k plans grew substantially, and in 2000, Social Security no longer reduced benefits for those earning higher incomes after reaching full retirement age. Then in 2006, the Pension Protection Act introduced additional features to retirement plans, such as automatic enrollment, and the use of the Roth 401k became more common, which essentially gave participants more options to diversify their tax strategies for retirement. So with this increase in options also came an increase in responsibility, as the burden of funding retirement had clearly shifted from companies to individuals at this point. Today, more than 80% of 401k plans offer the Roth 401k option, so it's really important to understand your different contribution options, which brings us into the next slide here. So today, most plans offer traditional pre-tax contributions and Roth contributions. There are also traditional IRAs and Roth IRAs that exist outside of your employer-sponsored plan. So we've listed them all out here to try to clear up some common confusion when it comes to these accounts. Traditional and Roth accounts inside of your employer-sponsored plan, like a 401k, have a maximum combined limit of $23,000, with those over the age of 50 being able to contribute an additional $7,500 on top of that for a total of $30,500. Additionally, there are also traditional IRAs and Roth IRAs outside of your employer plan. An individual can contribute $7,000 to these accounts in addition to a 401k account. And if you're over the age of 50, there's a $1,000 catch-up available to you as well. Now, let's talk a little bit about the differences between these traditional pre-tax contributions and Roth contributions. With the traditional pre-tax option, you're provided with an immediate tax benefit since you would deduct these contributions from your income taxes today. However, when you withdraw the money in retirement, you'll have to pay ordinary income taxes on those distributions. Alternatively, there's the Roth option, where you essentially pay taxes now and then are able to withdraw your money tax-free, assuming you've had the account open for 5 years and you're at least age 59 and a half. So a common question we receive here is, which account is better? And while there isn't a cut and dry answer, there are a few things you'll want to consider. So traditional pre-tax contributions might be right for you if you expect your income to be lower in retirement. So if you think your taxes are going down in the future, you may save by lowering your taxable income now and paying taxes after you retire. Alternatively, Roth contributions might be right for you if you expect your taxes to be higher in retirement. So if you think your taxes are going up, you may save by paying a lower tax rate today, or maybe you have a long time horizon to build those savings up because you're just starting out. While you pay taxes on what you contribute today, you won't pay taxes on the earnings or withdrawals in retirement, which can add up over your working years. Another consideration is that with traditional pre-tax contributions, you'll be required to start making distributions at age 73, but there's no distribution requirements from Roth contributions. In addition to understanding the different types of retirement accounts, it's also important to grasp how vesting works in retirement plans. So vesting refers to your ownership of the contributions inside of your plan. Remember that you're always 100% vested in any contributions you make to your retirement plan, whether those are Roth or traditional contributions. However, the employer's contributions may be subject to a vesting schedule, meaning that you may gain full ownership of those contributions over time. So there's really 3 main types of vesting schedules you'll want to be aware of. The first is immediate vesting, and with this schedule, all of the contributions that your employer makes become yours 100% right away. Then there's cliff vesting. Under this schedule, you become fully vested in the employer's contributions after a specific period, typically after 3 years of service. And then with graded vesting, you gradually earn ownership over the employer's contributions over time. So, for example, you may receive 20% ownership after 1 year of service, 40% after 2 years, and so on. And then after 5 years, you'd be entitled to 100% of the contributions that your employer had made. However, in this example, if you leave the company before reaching that 5 year mark, you may only be entitled to a percentage of your employer contributions. For instance, if you leave after 4 years, you may only be entitled to 80% of the employer's contributions, and the remaining 20% would be forfeited back to the employer plan. And then the last thing I want to touch on in this section is loans. So your plan may also allow you to take out a loan against your retirement balance and pay it back through payroll deductions. There are limits on how much you can borrow depending on your account balance. So you can borrow up to 50% of your account value up to a maximum of $50,000. Additionally, it's important to remember these loans aren't free. They're subject to an interest rate equal to the prime rate plus typically 1 or 2%, which does go back into your account as you repay the loan. For example, today's prime rate is about 7.75%, which means you'd likely be paying 8.75 to 9.75% in interest if you were to request a loan today. There are also payback periods to consider. General purpose loans typically have a loan term of 5 years, and loans on a primary residence can have a loan term of up to 15 years. But your employer can limit this. Some plans only allow for a 5 or 10-year loan term, even if the loan is still for a primary residence. Another consideration is that if you have a loan and you ever leave your employer, your outstanding loan could become due in full. And since there are very few plans that actually allow you to roll your loan over into another qualified plan. There's also typically administrative and maintenance fees charged for taking a loan, and if for some reason you end up not being able to pay that loan back, there's a 10% early penalty. And if you live in California, there's an extra 2.5% penalty on top of that for early distributions. So with that, I'll go ahead and pass it back over to Tina for our next section.
Okay, great. Well, let's just discuss some ways to maximize your contributions and retirement benefits. There are definitely some compelling reasons to save in a retirement plan. As we discussed previously, with life expectancy increasing, some workers may spend more time in retirement than during their working years, and Social Security may or may not cut it for everyone. So investing in a retirement plan is easy. Your employer will automatically deduct your contributions every time you're paid, so you don't need to remind yourself to write a check or send a deposit. And once this becomes a habit, most people don't even miss the money. And Antonia just talked about the potential for free money with matching contributions that your employer may make on your behalf. And whether you invest on a pre-tax or an after-tax basis, like in the Roth, there can be significant tax advantages. Additional benefits include cost-effective investing and professionally managed investment options. So you can build that properly diversified portfolio based on your specific risk tolerance. And the last point on this slide is often overlooked, but it's pretty important because qualified plans like 401ks, 403bs, 457 plans, they're generally protected from creditors or bankruptcy or civil lawsuits. A good example of this is if you were in an auto accident and someone decided to sue you and you didn't have an umbrella policy or assets to pay the settlement, they couldn't go after your retirement account assets. So Chad, I'm going to turn it over. We're going to do one more poll question.
I love it. All right, group. So poll number 2. Let me launch this thing real quickly. It's going to pop up on your screen if you're on a laptop or computer right now. If your employer provides matching contributions, are you contributing enough to get the full match? And where we go here, yes, no, my employer doesn't offer matching contributions. I hope most people here say yes. If you're not, you're literally leaving money on the table, right? Like this is the definition of free money. It's not free money you get to put in your check today to use, but it is free money for your older self. Like there's a fun app that is called the Aging Booth. If you don't know who you're saving for, load the Aging Booth app on either iPhone or Android. Take a picture of yourself and it ages you like 30 years. And it's a little bit surreal to see a picture of yourself 30 years from now. I did it. I still have gray hair, obviously, but I get a lot more like pudgy cheeks by that time. But it was an easy way for me to say, who am I saving for? That's who I'm saving for. So with that, I think most people have responded. Let me close this thing out. I'm going to share results with the group. Tina, Antonia, we have 76% of people say, yes, I am maximizing the match. 10% of people, no, I'm not. And 14% say my employer doesn't offer a match. It's not uncommon out there. There's a number of reasons, right? A lot of governmental agencies don't offer matches. So, a lot of pensions and unions and whatnot don't offer matches. So that's relatively common. I'd still say, even if they don't have a match, you want to save in your retirement plan at your employer because there's so many tax benefits.
Well, 76% is fantastic. This is a very engaged audience, so love seeing that. Well, let's talk about some other ways to maximize your contributions. The first place is knowing how much you can actually contribute into your plan. Antonia kind of addressed the limits for 2024, but for next year, you can actually contribute up to 23,500. And if you're 50 and older, you can contribute that additional catch-up contribution of 7,500. So totaling $31,000 annually. These limits do change every year, so it is important to stay updated. And as I'd mentioned earlier, being able to contribute up to your employer's match will definitely have a significant impact on your overall savings. Another strategy is to gradually increase contributions when you're able to. So for example, if you get an annual raise, perhaps increase your contribution rate by 1%. A good rule of thumb is to strive for a 15% savings target, and that will include your contributions and any employer matching contributions that you receive. And if you're 50 and older, you do have that ability to take advantage of those catch-ups. And so for this year and next, we talked about that $7,500, but next year, starting in 2025, for those ages 60 to 63, the catch-up contribution amount is actually increased from 7,500 to 11,250. So these folks have the ability to make a higher catch-up contribution, but once you turn 64, the amount goes back to that regular catch-up amount. This is something that Congress spent hours toiling over, and for whatever reason decided those were the age groups that were going to get this higher limit. And finally, reviewing your investment options on a regular basis is extremely important because you don't want to find yourself taking on too much risk in your portfolio, especially when you're nearing retirement. And it can be easy. This can easily seep in when we have markets that are going up, pretty steadily. You might find yourself just getting over allocated to equities. So always important to make sure that you're keeping in line with your target allocation based on your risk tolerance. So we'll talk about some of these investment strategies in the next section. So I'll turn it back to Antonia.
Thank you. So taking a look at some investment strategies here, the first one I want to share is dollar cost averaging. So this strategy involves investing a fixed amount of money in regular intervals, regardless of the market's performance. So what this does is help reduce the impact of market volatility by spreading out your investments over time, giving you the opportunity to buy at lower prices when the markets dip. And what this looks like in practice is you invest the same amount consistently, whether the market is up or down. And as a result, when the price of an investment is low, you end up buying more shares. And when the price is high, you buy fewer shares. And what this does is help smooth out market fluctuations, making it easier to stay invested over the long term without trying to predict market movements. And you might not realizing it, but by contributing to your retirement plan on a regular basis, you're actually already participating in dollar cost averaging. For example, if you're contributing $500 per paycheck into your 401k, you're consistently buying shares at different prices over time. And as you begin to invest, it's really important to build a diversified portfolio. In other words, you want to make sure you're not putting all of your eggs in one basket, so to speak. So typically, a well-diversified portfolio will be made up of a combination of stocks, bonds, and cash. Cash can be in the form of money market or a stable value fund, where you earn a small amount of interest. Bonds, on the other hand, are fixed income investments where money is lent to an issuer, such as the government or corporation, in exchange for a series of interest payments. And then there's stocks, which represent ownership in a company like Microsoft, Amazon, or Google. Companies often sell stock to raise money to expand their operations, and some stocks may also pay dividends when the company is able to share some of its earnings with shareholders, which is typically seen with more mature companies that have been around for a while. Additionally, there are several commonly used investment options that are likely offered in your retirement plan today. Capital preservation funds, such as stable value or money market funds, are designed to provide a predictable return over time and, as the name suggests, preserve the value of your investment. Alternatively, actively managed mutual funds invest in a variety of assets, including stocks, bonds, and balanced funds. They pool money together from multiple investors to create these diversified portfolios that are actively managed by fund managers, aiming to generate higher returns for investors. Index-based mutual funds, on the other hand, are passively managed funds that track a specific market index like the S&P 500. Since they do not require active management, index funds typically have lower expense ratios while still providing diversified portfolios. Finally, target date funds are portfolios that are designed based on your retirement timeline. So these funds gradually reduce your exposure to equities as you approach your target retirement date. For example, if someone has 45 years until they retire, they might have nearly 100% of their portfolio in equities. And as they get closer to retirement, the portfolio would automatically adjust to have a portion in fixed income and capital preservation funds as well. Additionally, target date funds automatically rebalance to maintain the right asset allocation based on an individual's target retirement date. So these funds are more ideal for someone who prefers a set it and forget it strategy, allowing the fund to manage the allocations for you over time and automatically adjust. And then the last investment strategy I want to cover is this one here, which is really my favorite. So with so many different strategies and investment vehicles to choose from, one of the most important strategies I think is to simply stay the course. So this chart here illustrates that by just missing the top 10 best market days, that can actually cut your overall return in almost half. And a lot of times, some of these best days come after some of the worst. So it's really hard to predict when those are going to happen. And that's why I think it's so important to understand yourself as an investor, get your asset allocation right, and then just stay invested. So prioritizing time in the market over trying to time the market can really save you a significant amount in the long run.
It's my favorite one too. That is probably the key thing if there's anything to take away from today. Well, since we've been talking a lot about accumulation, let's talk about kind of withdrawal strategies and taking the money out. So, we've talked a lot about, the road getting to retirement, but when you retire can have a long-term impact on your retirement goals. So imagine if you retired right before a major downturn, the Great Recession, .com, COVID. Even if you've done everything right when it comes to saving and investing, if you're unlucky enough to retire right before a major downturn, this could potentially increase your risk of running out of money because taking withdrawals in a declining market can have an adverse effect. And this risk is even greater if you invest too aggressively as you enter retirement. When you're younger, more risk can be fine, but because you have more time to recover from the market losses, but later on, you have less time to make up for some of that lost ground. So in an uncertain world, developing, following, and sticking with a plan is key. And there's a few types of approaches. This isn't all inclusive, but these are kind of the three main withdrawal approaches that we typically see. So the first is called flooring. And what this is just making sure that you have this base or floor of guaranteed income that covers your basic needs, basically your must-have expenses to maintain that comfortable standard of living that you're used to. And that guaranteed income could come from pension, Social Security, an annuity, a stable fixed income investment. And then the second one is systematic withdrawals. So, the trick here is kind of understanding what's the right withdrawal rate. And there's the widely cited, rule of thumb to withdraw 4% of your assets. And so how that would work is you take 4% out at the beginning of the year, and then you would steadily increase that amount based on, the potential of inflation. So let's say that you have the value of your retirement assets at 100,000 when you retire. And the amount you withdraw in year one would be 4,000 or 4% of that amount. And you could withdraw it at the beginning of the year and put it in a savings account, or withdraw it periodically throughout the year. But if inflation was running at 3% in year one, then in year two, the strategy would say that you'd want to withdraw $4,120, or 3% of that 4,000 would be your increase. So it's kind of tricky, but the rule is really meant to be a starting point, and then you kind of build in that inflexibility. But in this type of strategy, it is important to make sure that you are rebalancing your portfolio so that you're staying in line with your risk tolerance. And the other option that you do have is if your investments maybe aren't performing as well as you thought, you could adjust your withdrawal amount, or eliminate that inflation adjustment. Or on the opposite side, if your investments are performing well, you might be able to take out a little bit more. So there's a lot of hands-on involvement in this type of strategy, but it can be kind of a base to start with. And then the last one here is what we call kind of segmenting or bucketing your portfolio. And that just means you're investing for different time frames of when you think you're going to use the assets. So you could divide your portfolio among investments with different levels based on when you'll use it or withdraw it. So the first part could be, lower risk. That portion could be, for your must-have expenses and really covering you for the next 1 to 5 years. And then you might have an intermediate segment for expenses expected in the next 5 to 15. And that could be a mix of cash and bonds and stock. And then the final segment could be more of a higher risk portion for longer term expenses, maybe 15 years out. So just kind of a way to segment the portfolio and when you think you'll need it. So why don't we take a look at some withdrawal options that you may have available in your retirement plan. So while you're employed, you have a couple of distribution options available, in addition to the loans that Antonia discussed earlier. If you reach the age of 59 and a half, you might be able to take out an in-service distribution without any penalties, but this is only if your plan permits it. This option can be used to take out a portion of your retirement account early, and it could be to purchase, a specific type of investment that's not available in your plan, like real estate or an annuity. Most plans do allow participants to take their money out also in the event of an emergency or a hardship. So hardship withdrawals can be made for certain types of expenses, such as medical expenses, education cost, first-time home purchase, or a natural disaster. But it is important to note that not all the plans offer these options. So it is best to check with your employer before considering any of these distribution types. And once you are no longer with your employer, so it's post-employment, and that could be the result of you leaving or being terminated or retiring, you can do one of three things. You can leave your money in the plan until you need it. You aren't forced to take your money out. Unless your balance is below 7,000, there are some plans that do actually have a mandatory distribution where they roll it into an IRA. Not all plans, but some plans may have that if your balance is below that threshold. You can also take out a lump sum distribution. There may be penalties that are incurred if you haven't reached that age 59 and a half. Or you can roll it to another qualified account like an IRA or your current employer's retirement plan. And some plans do allow for these systematic withdrawals. So if you're retired and you want to create that income stream, this could be a good feature to get you started. But similar to the prior section, not all plans offer systematic withdrawals. So you do want to make sure you check with your employer if that is something you want to consider. And then for 2025, once you obtain age 73, you will be required to take required minimum distributions, or RMDs, from your qualified accounts. And this includes your retirement plan as well as your IRA accounts. However, if you have Roth accounts, they are not subject to RMDs. And that just started last year or this year. So that's a key distinction between having pre-tax money and Roth money. So one question we do get from a lot of our clients is, should they convert pre-tax to Roth? And there's a lot of things to consider with these types of transactions. The benefits of leaving your money in pre-tax accounts is that it will grow tax deferred, but you do have to pay taxes once you start taking that money out, and it really does depend on what you think the tax rates will be in retirement. But if you wanted to convert your pre-tax to Roth, you would have to pay those taxes on the amount that you convert in that tax year. But your money will grow tax-free as long as you've had the account for 5 years, and you don't have to take out required minimum distributions. So depending on your personal tax situation, this may or may not be the right strategy, but certainly worth discussing with a financial professional to see if it should be part of your retirement planning process. So Chad, we've got our last poll of the day.
I love it. All right, group. So I'm going to launch this thing right now. It should pop up on all of your screens for those of you with laptops or on the PC. The question here is, how familiar are you with your employer's retirement plan features? Right. So very familiar somewhat. I have no idea what features are available. And I'm not currently participating is what we have here. And so again, I think hopefully almost everybody is on the top 3. If you're not participating, let's have a bigger discussion. Just reach out. You got my email address and all the reminder emails, and I'm going to convince you to save in your employer's plan. But let me close this thing out. I think we have most people already responded, and I will share results with the group. We got 31% saying very familiar, 54% saying somewhat familiar. I think that's typically most common. 13% saying I have no idea what features are available, and only 2% saying I'm not even participating. So for that 2% of you, you have my email, reach out, I'll convince you. I promise. Just let's have a quick conversation. I'll convince you to save. Like, it's a no-brainer once we have a quick conversation. Let me turn it back over to these two.
Yeah. Well, a quick, easy way to learn about the features in your plan is to review a document called the Summary Plan Description. It might be available on your plan administrator's website, but your employer has it as well. It does get distributed to you, and it lays out everything about the plan so that you can, understand your match and distribution options and everything that's related. So not terribly surprised here with these results, because this is pretty indicative of the conversations that I've had with participants that they, for the most part are somewhat familiar. Okay, well, the next section, and this is going to be a fun one. So we covered a lot here, but we thought it'd be helpful to share some of the most common mistakes in retirement planning and how to avoid them. So mistake number 1, starting too late. So waiting too long to start saving can really result in a smaller nest egg, and it's really due to missed opportunities for that compound growth. So how can you avoid it? Start saving as early as possible. And even if it's just a small amount, compounding growth can have a big impact over the long term. And the second tip would be to automate your savings. So retirement accounts are designed to automatically take contributions from your paycheck. You don't have to do anything about it, but you do also have the option of automating savings outside of retirement plans. You can set a certain amount into a savings account or money market. So there are some other opportunities to save in addition. And then if we take a look at an example here, this chart will illustrate that Ellen starts investing at age 24, and James waits until he's 35. Now they're making the same monthly contribution of $100 with the same rate of return, but at the end, at age 65, Ellen will have $200,000 more than James. So this is really key. It really does make a big difference. And when we do talk to people getting close to retirement and they transition, one of their biggest fears is running out of money. So when you start saving and how much you save play an integral role in making sure that you can maintain a current standard of living throughout your retirement.
Yep. And the second common mistake is not increasing your contributions over time and not taking full advantage of your employer matching contributions, which can also have a significant impact on your retirement savings. So in this example here, let's see how the power of compounding can impact your savings. Here, assuming an individual is 35 years old and making a $40,000 yearly salary, if they were to save just 1% of their salary or $8 a week over the next 32 years, earning an average rate of return of 7%, they'd have just over $73,000 when they retire. However, if they increase that savings rate by just 2% to 3% of their total salary, that would increase to over $219,000 in retirement. And similarly, if they increase that to 5%, they could have over $366,000 to enjoy in retirement. So really, just a small percentage can have a huge impact on someone's retirement savings over time. So this is the reason we always tell people to invest early and often, even if it's just a small amount, because the power of compounding can have a huge impact on retirement savings over the course of 20 or 30 years.
Yes, let me go back to that real quick. I want to put another example in there just because we don't have the slide in here, but it's one of my favorites when I do these types of meetings for our direct employers, and it's a cup of coffee. And I think for everybody out there, like think a cup of coffee or a cup of tea if you don't do coffee, or a glass of wine or beer or scotch or whatever you do, whatever your thing is. Almost everybody has that one thing they do every day. And I like to think $2, $2 a day, cup of coffee. And if you do frappuccinos, maybe it's like $7 or $8 a day. So put that in perspective. But a $2 cup of coffee is $14 a week. It's about $700 a year. And over the course of a 40-year career is like $70,000 worth of savings when you think about compound growth, like Antonia just mentioned. So put in your head, if you can afford that cup of coffee, tea, or whatever other vice you might have out there, you can afford to put that same dollar amount into your retirement plan, and it's probably worth at least $300,000 or $400,000 over the course of your career. Sorry for the aside, guys. Back to you.
All right, mistake number 3, not diversifying. And really the failure to diversify can increase your risk in your portfolio and potentially reduce the potential for growth. So really important for diversification. And this is basically, the way to do this: spread your assets across a lot of these, different classes, as we talked about, stocks, bonds, and cash. And then, that'll help manage risk so that you can stay invested over the long run. And then make sure that you're rebalancing regularly. Adjust that portfolio on a regular basis. We recommend usually at least annually, just to make sure that you're aligned with your risk tolerance. And this can be done through your plan administrator could have rebalancing tools, but some of the investments automatically rebalance for you, as Antonia talked about earlier with target date funds. And if we look at, why diversification is so important, here's a chart that stems back 15 years to 2009. And at that time, we were coming out of the global financial crisis in 2007, 2008. And for the next 10 years, we were humming along pretty well until 2018. We had trade wars looming. The Fed began raising interest rates. Big tech was struggling because of data privacy issues. And then you fast forward 2 more years and we were struck with a global pandemic. But even through all of the worst, through all of that, the worst that a balanced portfolio or diversified portfolio did was down for almost 14%. And that happened in 2022 when we had stocks and bonds down at the same time. So an even more difficult task is when you're trying to figure out what asset class is going to perform well in any given economy. And as you can see, there's a frequent change in leadership from year to year. For example, in 2017, emerging markets were the best performer. But if you look in the next year, emerging markets went from first to worst. So having that diversified portfolio can just help you avoid being whipsawed when these asset classes move in and out of favor. And in practical terms, diversification is holding those investments that will react differently to the same market or economic event. So, for instance, when the economy is growing, stocks tend to outperform bonds. But when things slow down, bonds often hang on better than stocks. But if you hold them both, you reduce that chance of your portfolio taking a big hit when markets swing one way or the other.
Yep. And then mistake number 4 is underestimating expenses in retirement. So whether it be a failure to understand current spending or a failure to accurately estimate your future living expenses, this can lead to not having enough in savings throughout your retirement years. A common example of this is healthcare. So on this next slide here, according to a 2024 Fidelity study, the average retirement couple at age 65 can expect to spend around $330,000 on healthcare expenses alone in their retirement. So this is just one example of a large expense that many don't fully account for in their retirement years. And with the cost of healthcare increasing year over year, it's important to not only estimate how much you'll need when you retire, but to make sure you're estimating the increases accurately as well.
Yeah. So last mistake here is not considering taxes. Ignoring those tax implications of your retirement accounts can result in potentially unexpected tax burdens and possibly reduced income in retirement. So ways to avoid this: understanding the taxation, know the different types of accounts that you have, whether it's pre-tax or Roth, and don't overlook capital gains taxes that could be in your taxable accounts. And then another way would be to create a tax efficient withdrawal strategy. So consider the tax implications when you're withdrawing funds during retirement to make sure that you're kind of minimizing that tax impact. And that's why we typically suggest to have a variety, a mix of taxable, tax deferred, and tax-free accounts. And here's an example of kind of a rule of thumb of how you would start withdrawing from all of these different types of accounts. And the main thing that you want to do is defer taxes as long as possible. So if you own more than one account, it could be 401k, 403b, 457, you have traditional IRA, Roth IRA, the way to kind of start withdrawing these is to defer paying as much taxes for as long as possible, as I've mentioned, so that you can withdraw first from your taxable accounts, plus any RMDs or required minimum distributions, if that's applicable. And then you still need more. If you need more, you move on to withdrawing from your tax deferred accounts. And once you've used both of those up, then you can start withdrawing from your Roth accounts, allowing them to grow tax-free as long as possible. But there are exceptions to consider, which is why, we always advise folks to talk to a professional about the most appropriate withdrawal strategy that's right for you. So that's all we have today. Thank you so much. We can open it up for questions at this point. And Chad, I'll turn it over to you to sift through some of these.
I love it. So I'm gonna do questions both from Q&A and from chat, just that FYI. So if you don't have it, pull them both up. So first and foremost, top question, couple upvotes already. If you were to retire in March of 2025, can you save the full amount in your retirement plan? I mean, this question's specific to 457, but I know the same question out there for many other people, 401k, 403b, and your Roth IRA and your HSA for the same year.
My understanding is yes. It's not prorated if you're employed in that year, but knowing that 457 is being funded through payroll, so you would have to take steps to make sure that you're contributing that full amount. But you could contribute to your Roth and your HSA for that year.
Yeah, that's correct. I mean, a couple limiting factors just in case for all of you out there. Obviously, like it has to, like 457, 401k, 403, it has to come from your salary Limitations, I mean, you can't make more than what you want to contribute, right? Like obviously to one of these plans since it has to come from income, you have to make the amount that you want to contribute to it. I think the other one, and it's separate from your employer plan, but if you're doing an IRA or an HSA, you can actually contribute after year end. So employer plan by December 31st. Hard rule, no matter what, if you don't contribute, it's over. But your IRA and your HSA, you can, technically actually contribute until April, I think it's 15th this year. So, it goes back and forth based on weekends and stuff like that. But tax day 2025, call it mid-April, you can make contributions to your HSA or your IRA after year end 2024. So definitely work with your financial planner and your accountant if you want to make those contributions. Hopefully that was helpful. Next question I have here, also a couple upvotes. If you retire and leave the company, would leaving it in your employer plan cost more versus rolling into a regular IRA? Like think fees and employer plan, etc. I'll let you guys go with that. I'll usually have something to add here.
Yeah, I mean, it kind of depends. Depends on your employer. If you're with a larger employer, some benefits to what you have in institutional retirement plans is you typically are able to have access to lower cost investment vehicles outside of a retail account like an IRA. And usually you've got, lower negotiated fees. So rule of thumb typically is that, retirement plans, employer plans typically can be lower. It really just depends on, if there's investments that you wanted to invest in that aren't available in the retirement plan, that could be a reason to roll it out. But I would say from a fee perspective, you would typically see employer plans lower than retail accounts.
Yeah, I mean, I would echo that. I'd say it really depends on the employer, right? If you're coming from a very large employer, right, fees are so small. Unfortunately, like at the end of the day, this is a business of economies of scale. Small plans, like you tend to pay more. Large plans pay much less. IRAs are free other than the investment expense. I tell you, in an IRA though, you're looking at buying mutual funds at an expense ratio that you can afford. And it's one of those big things in a retirement plan. You're talking about all of the employees of one employer aggregating assets, and the exact same mutual fund might cost like 0.5% cheaper in your retirement plan than you can buy it for in your IRA. And so there is definitely a cost consideration to think about, even from an investment perspective, right? If you have, $100 million 401k plan versus your, $500,000 IRA, are you just paying more in investment expenses? And does it make sense to pay those administrative 401k fees to get into the retirement plan and to pay less? So a lot of things. Come talk to our team. We can flesh that out for you and just determine if it makes sense to stay in the plan or roll to IRA, and help you flesh that decision out.
Right. Yeah, that's a perfect point, Chad, is that, you really do want to do that analysis. But, at the same time, if you wanted to invest in exchange traded funds, those typically aren't available in retirement plans unless you have a brokerage window. So there could be reasons outside of just fees.
Yeah. So the next one I have for you, and Antonia, can you put it on the last slide that you put up? The question here is, and we have a couple upvotes too. I'm a little confused on the last slide, deferring taxes as long as possible. If you withdraw from Roth first, etc., wouldn't that defer the taxable account taxes the longest? Please clarify.
Oh, I see what you're saying. So because you're able to take, because the Roth, allows you to do tax-free, the suggestion here is that you want that account to really grow as long as you can, because you really don't know where taxes are going to be. And it just allows you to just take that money out when you need it. So, this is kind of the way that we've typically strategized with a lot of our clients, is taking out these taxable accounts, paying the taxes now, and then, continuing to just allow tax deferred and tax-free accounts to grow longer, because you're going to have larger amounts as they're growing that you're going to be able to take out tax-free.
Yeah, I'll extrapolate a little
Yeah.
bit. So put in perspective, right? Tax, like in retirement, I think a lot of people think they're going to go into retirement and they're going to use the same amount of money. And the reality is most people enter retirement and use less money, right? Like maybe your house is paid off, right? You don't travel as much as you thought you're going to travel. And you were saving into your retirement account at your employer. Now you're not. So maybe you were saving 15%. That means you were literally living on 85% of your income, right? You were saving 15 into the retirement account. Now you're not. So you have less income in retirement. Put in perspective in retirement, what if you use your taxable accounts, right? Your 401k, 403b, 457, et cetera, save your Roth accounts, right? You'll never pay tax on those. 1 year you have a big medical expense, right? And so you're already using, $70,000 a year, your tax bracket, you're doing that every single year in retirement for 10 years. And then one of you, either you, your spouse, whatever it might be, has a big medical expense. Wouldn't it be nice to have that big bucket of Roth assets that you could withdraw from that's tax-free and doesn't boost your tax bracket for that year? And you can take that Roth assets and pay for that medical expense. So I think when our financial planning team's working with clients, this is meant to be a rule of thumb, as it says at the very top of the page. It's not like the if, and, or buts. It's meant to be, again, just mental thoughts. But there's a reason for tax-free assets to have, it's just tax diversification, right? There's a place for it and it can save you in retirement, and just something to think about. We always recommend talk to your accountant and talk to your financial planner before you make those decisions. But again, rule of thumb, save Roth for the last bucket. Also, if you pass, Roth assets then transfer to your heirs and your beneficiaries tax-free too. So there's a lot of reasons why you might want to save your Roth assets for last. Like, again, yeah, if you use them first, does it defer taxes longer? Sure. But then do you transfer to your heirs taxable assets, right? Isn't it nicer to transfer tax-free assets to your heirs? Again, so not the one size fits all, but there's a lot of reasons why this is the rule of thumb out there. Anything else to add, Tina, Antonia?
No. I think that's, and I think, not everyone has that variety. But it is also something that's very specific to individuals' situations. So this is just kind of a broad rule.
Sure. Okay, so next question I have for you is for the 2025 catch-up. This is looking at super catch-up.
Okay.
Can you contribute the full amount if you turn age 60 during 2025? Can we do some explanation of the rules of that? This is also a little bit confusing topic, by the way, out there. So
yeah. So in 2025, if you are turning 60, you can contribute your regular deferral amount, $23,500. And in addition, your catch-up amount for that year will be $11,250. So both of those amounts can be contributed in 2025 if you're turning 60. You don't have to turn 60 in the beginning of the year. It can be any time during that year. That higher catch-up limit will be available to you.
Yeah. And I'll just add too, that'll be available for 4 years. So it's the year in which you turn 60 all the way up until 63. So for those 4 years, you're able to contribute that additional catch-up.
okay, next question. This is a good one. If you retire and withdraw from your Roth IRA, would earnings be drawn first before the contributions? Any considerations to think about there? I mean, I can start with that since all of it's tax-free because it's a Roth account. It doesn't actually matter if it's earnings or your contributions that are withdrawn. All of that Roth account is tax-free in retirement. So it doesn't matter.
As long as you've held it for 5 years.
Correct.
That's great.
Yep.
The only thing I'll add there too, though, is if you're making 100% Roth contributions inside of your employer-sponsored plan and you're receiving a match, that match will still be traditional. So even if you're contributing 100% Roth, you're likely still going to have some traditional pre-tax money in your retirement plan once you are ready to retire.
And again, that's specific in your employer account. In an IRA, there's no match.
Correct.
So, yeah. Okay, so guys, I'm going to pull one from the chat. I'm trying to go back and forth based on when they actually showed up, since we have no more thumbs up votes in the Q&A box. First and foremost, yes, I did put in the chat a link to the PDF. If you want a link to the slides that Antonia and Tina went through today, there is a link in the chat box that will also be in the email that our team sends out late tomorrow. Next one is, do you foresee any potential future changes to RMD regulations? This is an opinion one. I usually don't ask those, by the way, but I'm going to ask it for you all today. R&Ds can be pretty significant, and the minimum age, by the way, is actually age, I think, 73. No, is that right? Right, 73
Yeah.
in 2024.
73 next year.
Or 73 next year in 2025. But so, any thoughts, guys? I think actually we already have a idea from that. Go.
You have an idea? I don't see any potential at this point in time. I don't see any potential changes. If you have anything else to share, Chad.
Yeah, I mean, like at this point, it's anybody's guess. I mean, I would expect at some point they're going to increase it. Like it's going to go to 74 and 75. There's no telling when that happens, though, right? Like could it be a year from now or 10 years from now? Congress does what Congress does. We make a very clear point to not do politics on these sessions. And they don't always make sense, right? Even the super catch-up, why 60 to 63? Like, why isn't just over age 60? It's one of those weird things Congress did that Congress does. But yeah, will it go up? Almost definitely. When it goes up, your guess is as good as mine.
Yeah, that was part of the Secure Act. So you're right. The age limit will get increased. But as far as, the factor and how much they're forcing you to take out of the account, they have been extending it, which is good. I think it's being a reflection of what the workforce is doing and the fact that, folks are not retiring, at their traditional ages.
Yep. So the next one I have, and this again coming from the chat box, is latest news and articles have it that Social Security might run out by the year 2035. This person and their spouse don't really need Social Security, but they're thinking of, starting it early. And the question is, should they? Any thoughts on like the Social Security situation, when if they should take it early, should they wait, should they go later? I will post in the chat box from one of our other financial planners. He's very keen on this idea of means testing. And he did a BFSG short webinar on like, should you take it early and what should you think about? What does means testing mean? Because that's the big topic out there. But from the two of you, any thoughts as I post that real quick? I got to go find the link.
Yeah, and Chad, or Antonia, actually, if you want to go to page 42, I think it is, this will give us kind of an idea of, one of the reasons that, folks will wait. On the right side, this is the percentage of the full retirement, benefit that you would get. So, if your full retirement age is age 66, and that's if you were born between 1943 and 1954, you would get, that 100%, and then it goes up 8 percentage points all the way up to 132% of the full benefit at age 70. On the flip side, if you're, born after 1960, your full retirement age is 67. So, if you waited till age 70, you would get 124%. I think it really kind of, there's a lot of things that factor into this. One is, if you're not working and you're actually retired, there could be an argument to potentially take it early. But I can tell you that, one of the things that our planners do is run this analysis to see, based on kind of what your projected longevity would be, how much of the benefit you would be, because there is a, kind of a crossover point. So this is very specific. I couldn't give a broad answer on, whether it's right or not. I do think that is something that is very critical to your full plan. So I would definitely talk to someone about this before making any decisions, because it definitely can have an impact on, just your overall retirement plan.
Yeah, I mean,
That's
what
all
I would
I
add to
have.
that is so I did post the link. It's Social Security ID as I posted the YouTube link. It's like a very short video. I think it's like maybe 5 or 10 minutes, maybe 5 minutes. But what it gets into, I think the big crux of it is the day they're going to do means testing, they're going to announce it. And if you haven't taken Social Security, you'll be able to start taking Social Security before means testing is actually available or a thing. So don't rush into it just because you're worried about that. What means testing is, just for those of you that may not know what that is, it's this idea out there that Congress is muddling with. That says if you have enough money to not need Social Security, they're not going to give you Social Security, right? So if you can afford to live on your own in retirement, we're going to save Social Security for those that need Social Security. And obviously, everybody paid into it. Everybody should be entitled to receive a piece of it. But Congress is truly muddling that idea out there. And so I think a lot of people are concerned, maybe I don't get any Social Security because I have saved enough for it. So definitely put it in the back of your head, pay attention, watch for it with the news coming out of Congress. But as of now, means testing is not a thing today. So definitely talk with your financial professionals, your CPAs and accountants, and figure out what might be best for you over time. The next question I have for you too is I am 62, planning to work for the next 3 years and then use savings and 401k to fund myself. Wait until like about maybe 70 years or so to make Social Security work. In the lights of the recent election, should I be concerned that Social Security could cut my money out? Right. And I'm not going to get anything is the crux of this, which is right on the back of our last question. Any thoughts?
Yeah, I mean, we don't really know. Again, I think it does just play out into your overall plan. Everyone has a very specific situation. So, to me, it just seems like it's something that we can't project whether the money's going to be there. I think, if we have a collapse of Social Security benefits, we're going to have a lot bigger issues going on with the country and the economy. So, I think we, plan with the, intent that it is going to be there, and it's part of an overall plan that you put together. So I don't know. I don't want people to be concerned at this point, but at the same time, we really don't know kind of the future state. But I just not to beat a dead horse, but I do think it is part of, putting together and seeing how it all fits together within your current situation.
Yep, I like it. And so it's funny because I have another question on a similar route. And so let's keep politics out of it as much as possible, you two, but this is coming from the chat box. Considering the results of the recent election, any suggestions on how to manage your future investments? Let me start with that. What I could tell you is Democrat, Republican, whatever you want, whoever the person is, it has, from a stock market perspective, been irrelevant for the last 200 years. We all put a lot of stock into, these people's policies are great for the economy. These are not great for the economy, blah, blah, blah. From a, honestly, stock market perspective, it hasn't mattered. And so that's why we try to keep politics out of it, is we're thinking about long-term perspectives from your portfolio and your investments. But for the two of you, any thoughts?
Yeah,
Well, the market. Oh, go ahead, Antonia.
I was just going to add to that saying, regardless of who's in power, you always have a little bit of control on your side. So investing early, often staying the course is going to help you over the long term, regardless of who's in power.
Yeah, and I mean, I can tell you that, right after the markets told us what they liked about the, administration coming in. They like tech, they like Bitcoin, cryptocurrencies, but at the same time, it's still going to rely on whether these companies can perform, whether they can be profitable, and the markets will normalize based on that. So we had a lot of hype. We always kind of have that little bounce, but things will, kind of come back and revert back to, typically what we have with averages. So I agree. I think keeping that long-term perspective, and not really trying to, kind of figure out what's going to work within the next 4 years, probably doesn't have a place in a long-term plan.
Okay, group. So the next one I have for you two is, it runs along the same lines. So with the possibility of Social Security being reduced or cut, how do you even plan to think about the difference, right? And how to make up the difference. And I'll kick you off with that is start saving now, save more now, right? Nobody gets to retirement and says I have too much money, right? It just means instead of a Camry, you drive a Ferrari, whatever that might be. But I think the real big answer to that is Social Security the monthly average benefit was, I mean, what, like $1,500? It's a little bit more than that, like per year for this year. I mean, nobody can live off of that. But making up $1,500 in retirement is a matter of saving like another $100 per paycheck, maybe for a whole career.
Yeah, go ahead.
Oh no, that's it. I just
Yeah.
the whole career, $100 a check, maybe might make that up. I mean, it's anybody's guess. It really depends on your lifestyle, where you live. I know we have a California heavy audience, but we have New York and New Jersey and Texas and Florida. We have like this is a nationwide audience here. I can tell you, I have clients in Idaho that need a lot less than those that live in California. You're right, like just the difference in lifestyle, the difference in what they want to do, the difference in their housing costs, etc. Things change based on where you live and what you want to do in retirement. So there is no way we can answer that question holistically for any one individual. It really gets into, it's a very individualized answer.
Yeah, it is. But if you are a few years out from retiring, obviously there are some things, putting more money away, saving, reducing expenses. Um, there's certainly some things that can be done. But again, I think, at this point, I wouldn't just rule out that Social Security is going away. We've had these conversations in the past. So I wouldn't. I don't know that I would necessarily rely on it 100%, but it can play part of your plan. It can pay play a specific portion of your overall plan. So kind of take that for what it's worth. But I think you have to kind of think through if you're a few years out, what's your retirement going to look like? What kind of spending are you going to do? Figure out kind of where you are. To me, you're a really good candidate for making sure that you put together a plan or at least kind of have an assessment of where things sit today.
Okay, so if you guys are looking at the Q&A box, we don't only have two. I'm going to ask a couple questions from the chat box after this. But first and foremost, I'm retiring in 2 years. Is it too late to change my upcoming contributions to Roth?
No, absolutely not. You certainly can. And I don't know if you're referring to your Roth IRA or your Roth in your retirement account or your retirement plan, but you can certainly make those changes. Usually it's you're able to make them at any pay period. So
Yeah, I mean, let me add to that a little bit. So is it too late? The answer is never. It's never too late to start Roth. I would caveat that if you need the money when you retire in 2 years, putting it in your Roth is not optimal because Roth is subject to a 5-year rule, right? Like the account has to be open for at least 5 years. That starts January 1st. So if you start contributing Roth for the first time ever today, November 20th of 2024, the clock started January 1st, 2024, but the money is not actually available for you to take in retirement, even if you're age 59 and a half, et cetera, until the year 2029. If you take it, there will be penalties because you took your Roth assets early. So if you need the money, definitely do not start saving Roth in that regard. But if you won't need it and you can start saving Roth today and you won't need it until say the year 2030 or so, and you can rely on Social Security or your pre-tax or other investments, yeah, definitely start saving Roth. Start accumulating as much money as you can. Like get that 5-year clock started ASAP. I think most of our financial planners would help you. Even your first couple of years of retirement, let's convert some of your pre-tax money into that Roth account if you don't need it when your income goes down a little bit. So it's never too late. Just if you need the money, be cognizant that there is a 5-year clock.
yeah,
That's a great point. I think especially before you retire is a good time to start looking at, rollovers and transferring that money from one bucket to another, doing the conversions as well.
Okay, so next one I have, and they actually just put it into the Q&A box. I was gonna read it out of the chat box. Thank you so much for putting that in the Q&A box. But when you're trying to estimate your monthly expenses and needs in retirement, do you use today's expenses or do you try to estimate the future amount based on inflation?
Well, I'm trying to think, when we go through our planning software, we put everything in, but it does get projected. So we do project what those expenses could be, but then we're also projecting what, the growth of your investments alongside of that. So everything gets put in today.
Inflation is projected, by the way, in the software.
Yeah, yep.
So I mean, the short answer is yes, we do definitely use inflation in our projections at all times. So we would expect you to do too. I think the best example I have, the only thing I know today that has not gone up as much as inflation is like an In-N-Out double. For those of you on the East Coast that don't know In-N-Out, come to the West Coast and try it. But a double is like still, I don't know, it's like $5, $6. And the $6 burger at Carl's Jr. is now like $10. And so like inflation's a thing. In retirement, the cost of everything that you buy, right, is going to go up over time. And so everything that we do when we're projecting out for the next 30 years of everyone's life and our client's life, we do bake inflation in, saying if you just put it in cash, right, for 10 years, you would have made zero after the global financial crisis. And today you might be making 5%, right? But it's a very stark difference from 5 years ago to today in your cash account. So how much do you spend and how much will you need? All inflation is a huge factor in that. We always bake that in.
Yep.
Next one I have for you too is, and this is coming again from the chat box. If I already do the catch up, so this is somebody that's over age 50, for the 3 years before age 60, I did catch up. So 57, 58, 59, etc. Can I still participate in this new super catch up?
Of course. Well, I guess we have to, I don't think there's any limitations in the 457 plan, but yes, if you are making your catch-ups from 50 to 60, when you turn 60, you can certainly make that higher catch-up limit. There's no restrictions there.
Okay, so the next one, and I'll start with this one, but then I'll leave it to you two. But piggybacking off of one of our last questions, how would someone estimate their medical expenses after retirement, right? Especially if they're currently a very healthy person. And what I tell you is, I mean, Fidelity did a really cool report on this a number of years ago that shows the average couple. I don't have a statistic for individuals. If you're single, I'm sorry, but maybe just cut it in half. But the average couple out there in retirement is expected to spend around $300,000 in retirement alone. And this is a healthy couple. This is not like I smoked my whole life, like cigarettes and all these fun things, and I'm an alcoholic. No, this is a healthy couple is expected to spend about $300,000 in retirement. So yours truly, former cigarette smoker, don't smoke them anymore. I'm probably expected like $500,000, right? Just because like there's health impacts for like some of my past life and prior choices. I hope that puts that in perspective, but it is not a small burden that you're going to have in retirement. But anything for Antonia and Tina, anything to add to that?
Yeah, no, it's definitely going to be a large expense, and we really don't know. There can be everything from potentially having to need long-term care. I think that to me, this is one thing that you don't want to underestimate. And this is where HSAs, if you're eligible for them, can certainly come into play, but I've got a little side account I'm using to fund for healthcare, in addition to the HSA, because I think that there's a lot of unhidden expenses that could come out of that.
Okay, so the next one I have for you, and Tina, this is one after your heart. My company gives stocks annually as part of our performance reviews. They have a 5-year vesting schedule. Can you talk to us about the rule of 65, not 55, to differentiate the video that you made for us? Where maybe once I turn 65, I keep working, I would no longer need to wait the standard 5 years to vest. It actually still applies to the same rule of 55, by the way.
So where is that question? I'm not
In
sure
the
I'm
Q&A.
following the stock versus the vesting. Is that what we're?
It's in the Q&A box.
Okay. Okay, so my company's Gives stock annually. Okay.
So I'll give you, I mean, the short answer, like,
Applicant, no longer need to wait the standing
if
price
you
to vest.
terminated employment on or after the age of 50, but before 55, and the sum of the award's recipient age and years of service add up to 65 or more of the employment termination date. That's something straight from SEC. So we might
So
need
I think, well, you know, because I mean, we're talking about employer stock here. So
correct.
if I'm reading this, you're saying that once you turn 65, you've reached full retirement, you no longer need to wait that standard 5 years. You're automatically 100% vested. That could be, that, I worked for a large company, had employer stock. That was, if you retired from the company and it had to do with, your years of service and your age, you became 100% vested in your stock. So I think it can also be specific to the company rules and the stock grants that they're providing. So
Yep, I love it.
yeah,
That's
that's kind of where I would
it's,
go with that. I don't know for sure.
it is company dependent. It's, I mean, in their covenants and as they give those grants, they're going to put their own rules. There's no IRS rule around how these grants work, right? It is very specific to the company and the grant that you're receiving. Okay, so we have a number of questions still coming in. So the next one is following up on the Roth 5-year requirement. Is the 5-year rule actually for the contribution in dollars or is it account based? i.e., $1 in 2024 would allow me to take that amount out in 2029. Can you expand on that?
Yeah, it's basically when you invest your first dollar, that's when the clock starts. So that example would apply. You put $1 in 2024, you would be able to take out 2029, you'd be able to take out the account tax free.
Yep. And again, that does apply to every other dollar that you put in. So it is account based, right? You put a dollar in 2028, it's still eligible to come out in 2029. The 5-year clock starts January 1st of the year of contribution. So you put it in December 1st of 2024. Technically, it started January 1st, 2024. 2029, every dollar can come out. Now, there is a catch to that. If you do Roth conversions, which we did address at, on I think one slide of today's presentation, Roth conversions are treated differently. Every Roth conversion, so pre-tax moves to Roth, starts its own 5-year clock. So if you're going to do a conversion from pre-tax to Roth, our team usually suggests, right? You have your Roth IRA with that like 2024, January 1st, like 2029, you can take the money out. Maybe you want to do a Roth conversion in 2028, set up a new Roth IRA to convert money to. And the reason for that is that 2028 Roth conversion is going to have its own 5-year clock. So you don't, like, it's really difficult to commingle different buckets of 5-year clocks, right? So if you know one bucket of money is 2029 eligible to come out, but then you convert money into that account that's not eligible till 2033, right? That starts to get hard to manage. So having different accounts for conversions and only Roth conversions. I know 90% of people on this webinar will not need Roth conversions, but for those of you that will do Roth conversions, just put that perspective in mind. Roth conversions, every conversion has a new 5-year clock. Cool. Okay, next question I have for you. We're coming up by our last two we have here going. Can I open a Roth IRA if I don't have a big sum to start with, maybe $100, $500? I would contribute to a Roth each paycheck. Or is the answer to contribute to savings and when you reach a big amount, then open a Roth? I mean, I'll start with that. I mean, what I would do is open your Roth with $100. If you have $100, open the Roth account today. It starts your savings. Just keep it in cash. You don't even have to invest it. The point is to have a Roth account like your Roth IRA and start that 5-year clock. If your employer has Roth in your retirement plan, like 401k, 403b, 457, it's just a matter of changing your contribution from pre-tax to Roth. It will start that clock immediately on your next paycheck. And you will have a Roth account. It's not a separate retirement account, right? It's still your employer's account. It's just a pre-tax bucket and a Roth bucket, and your record keeper accounts all of that stuff, and it just starts the clock automatically. You see one big balance still, and you just have money in both money types. So very simple.
Yeah, and I think it kind of goes back to what Antonia talked about earlier, is if you can open something up, even with $100, and then on a regular basis, continue to contribute your dollar cost averaging into the market and, able to kind of create that habit. So, but you have to make sure that you're following the limits. There's contribution limits to the Roth outside of the plan.
So the next one I have for you is, do Roth conversions after age 15 and a half start a new 5-year clock? i.e., is the Roth 5-year clock even a thing after age 15 and a half?
Not that I'm aware of.
If you don't have a Roth account, the answer is yes. Like a Roth account in general has a 5-year clock no matter what. So you could be age 70 with no Roth account. If you set up a Roth account and you put money in, it starts a 5-year clock.
5
no
years,
matter what.
yeah.
The 5-year thing is a thing for every Roth account, no matter what.
I just don't think the age 59 and a half is.
For Roth, it's the 15 and a half is just not ultra relevant, right? It's they think for pre-tax and Roth accounts, you can't take money out without a penalty until you're age 59 and a half. That's the same rule for pre-tax and Roth. The 5-year rule has nothing to do with age 59 and a half. It is specific to Roth accounts. Like the Roth account has to have been set up for 5 years, period, to be able to take money out penalty free.
Mm-hmm. But, what we didn't kind of mention, there was a caveat. We talked about these kind of Roth conversions. Some retirement plans do allow you to do this within the plan.
Yep.
Rather than having to have a distributable event or, reaching 59 and a half where you could actually take an in-service withdrawal and take that money and move it into a Roth. So there could be the ability to do it within the plan. But you would have to wait until you're 59 and a half or have an event to allow you to take money out and then move it into a Roth IRA.
So that's the last question. I want to thank everybody for staying on. We have one more in the Q&A box, but it's more of a comment that I'm going to share because I think it's actually really fun. But before I do that, I did just post in the chat box again, as a reminder for everybody, a link to the PDF of today's slides in case you just want the slide deck. You will get 2 emails tomorrow from us, one from Zoom directly that we have nothing to do with it, that just comes automatically, that includes the replay link, and then one from our team that includes this, the PDF, and some replay stuff as well. But as we wrap this thing up, last one, fun comment from one of our attendees today that we should have an option to opt out of Social Security. Of course, opt out means you don't get any, but at least that money doesn't go to Social Security and we could put that in our retirement funds to invest it. I don't disagree with that, actually. I think that would be great.
That'd be awesome.
And unfortunately, it's kind of a Ponzi scheme. We need money to keep going in to pay all these other distributions. So
that's it. And our team at BFSG has no affiliation with the U.S. government. We're just here for educational purposes. We don't really get a vote in that. We're voting just like all of you. But hopefully you all enjoyed today's presentation. Hopefully you found it useful. This is the last installment of our fall webinar series. We will be back in the summer for summer webinar series. I know our team is on the background, potentially talking about a midterm, maybe early next year webinar series. We have some really fun topics I think our team wants to bring to the group. So we might have an interim one. Otherwise, we'll see you all back here in July. Thank you so much for attending today. Antonia and Tina, any closing remarks as we loop this thing out?
Well, I think it was pretty obvious that we feel very strongly about making sure that you have a plan, whether it's, to just save for a goal or saving for retirement. And, obviously not to be so concerned about what's going on in the markets in the short term, but really following a long-term strategy. That would be my 2 cents. Antonia?
Thanks everyone for joining. Really we're here as a resource to educate you. If you have questions, please feel free to contact us as well offline.
Antonia, before I get fired by compliance, can you put that disclosure slide up real quick? There we go. That's what I need for all of you. There's a lot of it there. It's all on our YouTube as well. Thank you everyone for attending today. We hope you have a great rest of your day.
Yep. Thank you everyone.